$94 to $88. Silver in hours. War, oil, and Chinese demand. Said go up, someone said go down. While you were sleeping, silver collapsed $6 in mere hours. But here's what they're not telling you. China's biggest gold platforms crashed this morning. Physical stores stopped selling investment bars entirely, and desperate buyers are now paying a $1,000 premium for decorative gold pieces. War is escalating. Oil is surging. Chinese demand is hitting records. Every single indicator screaming buy. So why did someone dump billions in silver in the middle of the night? Who has that kind of power? And what do they know that you don't? Welcome to Currency Archive. If you've made it this far, you're someone who values truth over headlines. My friend, if you appreciate this kind of deep financial intelligence, the kind your grandchildren will thank you for understanding, would you do me the honor of subscribing? Just one click, that's all it takes. And tell me, where in the world are you watching this from today? Are you in the States, Europe, Asia? Drop your location in the comments. I read every single one. Now, let's uncover what really happened in these critical hours. The financial markets opened Monday morning with a mystery that left analysts scrambling for answers. Silver prices had collapsed from $94 to $88 in a matter of hours. Yet every fundamental indicator suggested the price should have been climbing higher. This was not a normal market correction. Something deeper was happening. Something that revealed critical fractures in how precious metals are actually priced in the modern financial system. Over the weekend, while traditional Western markets remained closed, alternative trading platforms were painting a very different picture of silver's true value. Kinesis, a platform that trades physical-backed digital silver, showed prices hovering near $100 per ounce. Hyperliquid, another crypto-backed metals platform, displayed silver at $96. These were not speculative numbers. They represented actual transactions where real silver changed hands. Western spot markets had closed Friday afternoon at $93 for silver and $5,278 for gold. The weekend premium on physical-backed platforms was significant, and it was telling traders something important. Those who understood what they were seeing recognized this gap as a preview, a warning of what would happen when Monday arrived. The prediction proved accurate in the opening minutes. Silver gapped upward from $93 to nearly $97 when markets opened. Gold punched through the $5,400 level with conviction. The weekend premiums had correctly forecasted the direction. The physical market was leading and the paper market was following behind. But then, something unexpected occurred. Within hours, silver reversed violently. The price that had opened near $97 crashed back down to $90. Gold, which had broken above $5,400, retreated to $53.46. The bullish opening evaporated as if someone had flipped a switch. This reversal created the paradox that demanded explanation. War tensions were escalating in multiple regions. Oil prices were surging higher, raising inflation concerns across global economies. Chinese demand for physical precious metals was hitting unprecedented levels. Their e-commerce platforms were literally crashing under the weight of buy orders. Every traditional signal that drives investors toward precious metals as safe haven assets was flashing bright red. Yet the price was falling. Market analysts reviewing the data faced a fundamental question that had no simple answer. If demand was rising and geopolitical risk was increasing, who was selling billions of dollars worth of silver contracts in the middle of a supply crisis? The contradiction revealed something most investors never consider, that price and value are not always the same thing in modern markets. There are three separate regimes operating simultaneously in precious metals today. The Western paper markets, dominated by futures contracts and derivatives traded on exchanges like COMEX. The crypto-backed physical platforms, where digital tokens represent actual metal held in vaults, and the Asian physical markets, where consumers and investors buy tangible bars and coins for delivery. These three regimes do not always agree on price. More importantly, they do not always agree on who controls price discovery at any given moment. Historical precedent shows that similar divergences have appeared during previous market stress periods. In 1980, when silver spiked to $50, the futures market became disconnected from physical availability. In 2011, during the European debt crisis, premiums on physical silver coins exceeded 20% above spot prices. In March 2020, during the pandemic panic, physical metals became nearly impossible to source even as futures prices fell. Each time the pattern was the same. Physical scarcity appeared while paper prices remained suppressed or fell. The question for serious analysts was not whether this divergence was unusual, but rather what it signaled about the structural stability of the current pricing mechanism. Business leaders and capital allocators watching these developments understood the implications extended far beyond precious metal speculation. This was about understanding how markets function when stress enters the system, how price discovery breaks down, and how different participants with different time horizons and different access to physical assets create temporary distortions. For portfolio managers responsible for hedging strategies in an uncertain geopolitical climate, this divergence represented a critical warning. The mechanisms that normally keep markets efficient were showing signs of fracture. What happened Monday morning was not just a price move, it was a masterclass in regime dynamics. It revealed who has the power to set prices during Western trading hours and who does not. Understanding why the price fell despite rising demand requires examining what was happening 8,000 miles away, in the world's largest gold-consuming nation. That examination reveals a crisis unfolding in real time. While American traders were sipping their morning coffee and reviewing overnight charts, a financial earthquake was already underway in China. The numbers coming out of Chinese e-commerce platforms were not just unusual, they were unprecedented. China's largest online marketplace had adjusted gold prices to the equivalent of $5,574 per ounce. This was already a massive premium over Western spot prices. But what happened next exposed something far more significant than a simple price divergence. The gold ran out. Major physical gold retailers across Chinese cities began refusing to sell investment-grade gold bars entirely. Store managers posted notices explaining they had exhausted their inventory. The only products remaining were craft gold bars, decorative pieces designed for gifts and ornamental purposes. These craft bars were being sold at the equivalent of $6,329 per ounce. Let that figure settle for a moment. Western spot gold was trading at $5,346 as this crisis unfolded. Chinese retail buyers were paying nearly $1,000 more per ounce. Not because they wanted decorative gold, but because nothing else was available. This was not a premium reflecting shipping costs or import duties. This was the price of scarcity showing its face in the world's most important physical gold market. Then the digital infrastructure buckled under pressure. Jingdong Finance, operating gold accumulation products, in partnership with Jiashang Bank on China's dominant e-commerce platform, experienced what officials described as severe congestion when markets opened Monday morning. The platform simply could not handle the volume of buy orders flooding the system. Millions of Chinese savers were attempting to convert yuan into gold simultaneously. The question analysts needed to answer was why this demand explosion was happening now, and whether it represented a temporary panic or something more structural. Multiple factors were converging to drive Chinese capital into precious metals. The yuan had been experiencing gradual devaluation pressure against the dollar throughout recent months. Chinese citizens, who face strict capital controls limiting their ability to move money offshore, were watching their purchasing power erode. Precious metals represented one of the few legal hedges available to ordinary savers. But currency concerns alone could not explain the intensity of the buying pressure. Government policy signals were creating deeper anxiety about the safety of holding yuan-denominated assets. Chinese authorities had been quietly reducing their dollar reserve holdings while increasing gold reserves held by the central bank. When a government begins accumulating an asset while restricting its citizens' investment alternatives, sophisticated savers notice the pattern. They were following their government's lead. Historical precedent made the current situation more concerning. During the capital flight episode of 2015 and 2016, wealthy Chinese citizens moved an estimated $1 trillion out of the country through various channels. Authorities responded with harsh capital controls that remain in place today. Those controls created a pressure cooker effect. Chinese savers with few legal options for protecting wealth were channeling money into the remaining available vehicles, and physical precious metals sat at the top of that short list. The mainland Chinese investment landscape offers limited alternatives compared to Western markets. Real estate, once the preferred store of value, had become a dangerous bet following the property sector crisis. Stock markets remained volatile and subject to unpredictable government intervention. Cryptocurrency trading faced severe restrictions. Foreign currency holdings were capped at minimal amounts. Gold and silver became the default refuge, not by choice, but by elimination of alternatives. This created a fundamental problem that Western analysts often overlooked. Chinese buyers could not simply purchase precious metals from London or New York markets to satisfy their demand. Capital controls prevented the free flow of money across borders. Import duties and regulatory frameworks added layers of friction to cross-border precious metals transactions. The logistics of physical delivery across jurisdictions introduced delays and costs that made arbitrage nearly impossible for individual buyers. The Shanghai Gold Exchange, China's domestic trading venue, was showing price spreads versus COMEX that had widened to levels not seen in years. This was not inefficiency. This was the market adapting to segmentation. Two separate precious metals markets were operating under different rules, with different participants unable to freely trade between them. The basis? The difference between physical and futures prices was expanding because the normal arbitrage mechanisms that keep markets aligned were broken. Traders in London could not easily deliver physical gold to desperate buyers in Shanghai. Chinese buyers could not wire funds to New York to purchase COMEX contracts. The result was a bifurcated market where prices reflected local supply and demand conditions rather than a unified global equilibrium. For Western institutional investors, accustomed to assuming markets remain efficient and connected, this divergence carried a critical warning. The infrastructure that normally keeps global prices aligned was showing stress fractures. The sustainability of Chinese demand became the central question. Was this a panic-driven spike that would fade within weeks, or had something fundamental shifted in the world's largest gold-consuming nation? The answer would determine whether physical supply tightness represented a temporary disruption or a structural change in global precious metals markets. But understanding Chinese demand was only half the story. The other half required examining what happened when Western paper markets opened, and why billions of dollars in selling pressure appeared exactly when physical markets were screaming for metal. That examination reveals the true architecture of modern precious metals pricing. The architecture of modern precious metals pricing resembles a theater where the audience believes they are watching reality, but the stage is controlled by mechanisms most observers never see. Understanding what happened Monday morning requires looking behind the curtain. COMEX, the primary futures exchange where silver and gold prices are discovered during Western trading hours, operates on a structure that would surprise most casual investors. The contracts traded on this platform represent promises to deliver physical metal at a future date, but the vast majority of these contracts never result in actual delivery. They are settled in cash. This creates a mathematical curiosity that defines how prices move. The ratio between open interest, the total number of outstanding futures contracts, and registered physical inventory available for delivery has reached levels that would be considered impossible in most commodity markets. At certain points, the paper claims on silver have exceeded the physical inventory by ratios of 100 to 1 or higher. 100 investors holding contracts, but only 1 ounce of actual silver backing those claims. This is not a conspiracy. It is simply how the system was designed to function. Futures markets were created to provide price discovery and hedging mechanisms, not to facilitate physical delivery. The leverage built into the system allows traders to control large positions with relatively small capital. A trader can control 5,000 ounces of silver with a margin deposit representing only a fraction of the full contract value. When prices move, that leverage amplifies both gains and losses. Monday morning's sell-off was not driven by physical metal changing hands. It was driven by margin calls, algorithmic triggers, and cascading stop-loss orders executing in a leveraged paper market. The timeline of events revealed the mechanism clearly. Markets opened with silver gapping higher to $97, reflecting the weekend premium that had built up on physical-backed platforms. For approximately 1 hour, the bullish sentiment held. Then, selling pressure emerged at a key technical resistance level. High-frequency trading algorithms, programmed to recognize chart patterns and react within milliseconds, detected the failure to break above resistance. Sell orders began hitting the market in rapid succession. Traders who had bought silver on the gap up were suddenly underwater on their positions. Margin requirements meant they faced automatic liquidation if prices fell below certain thresholds. As those thresholds were breached, forced selling accelerated. The algorithms fed on themselves. Each wave of selling triggered more stop-loss orders, which triggered more algorithmic selling, which triggered more margin calls. Within hours, billions of dollars in notional value had been wiped from silver positions. Yet virtually no physical metal had actually changed hands. This exposed the fundamental reality of precious metals pricing during Western trading hours. The marginal price, the number displayed on financial news tickers worldwide, is set by whoever is willing to trade the largest volume in the futures market during New York hours. Physical demand in China, premium pricing on crypto-backed platforms, supply shortages at retail dealers, none of these factors mattered in the moment when leveraged selling pressure hit COMEX. The paper market controlled the price. Authorized participants and bullion banks play a crucial role in this ecosystem that retail investors rarely understand. These institutions have the ability to create and redeem shares in precious metals exchange traded funds, to settle large futures positions, and to influence short-term price movements through their hedging activities. When these institutions adjust their hedging positions in response to changing market conditions, the resulting order flow can move prices significantly. Monday's sell-off coincided with options expiration calendar events and quarterly positioning adjustments by managed money funds. Data from the Commodity Futures Trading Commission showed that speculative long positions in silver had reached elevated levels in preceding weeks. When prices failed to continue higher after the opening gap, professional traders began reducing exposure. Their selling did not reflect a view that Chinese demand was weakening or that geopolitical risks were declining. It reflected technical positioning and risk management protocols in a leveraged derivatives market. The regime dynamics became crystal clear in this moment. During Asian trading hours, when physical markets dominate activity, prices reflected actual supply and demand for metal. Premiums expanded, platforms crashed under buying pressure, and inventory disappeared from retail stores. During Western trading hours, when futures markets dominated activity, prices reflected the flow of margin calls and algorithmic trading strategies in a leveraged paper market. Two completely different pricing regimes, operating under different rules, creating different outcomes. The question serious analysts faced was which regime would ultimately prove dominant. History offered disturbing answers. In 1980, futures market manipulation through margin requirement changes had crushed silver prices, even as physical shortages persisted. In 2020, during March pandemic panic, futures prices fell while physical coins and bars became impossible to source at any reasonable premium. The paper market could suppress prices for extended periods, even when physical fundamentals suggested prices should rise. But history also showed these divergences could not last forever. Eventually, if physical demand remained strong enough and supply remained tight enough, the derivatives market would be forced to reconcile with physical reality. The mechanics of that reconciliation historically involved violent price moves as short positions scrambled to cover and delivery demands stressed the fractional reserve system. The structural vulnerabilities in the current system were becoming more visible. Bid-ask spreads in physical markets had widened significantly. Delivery delays on large orders were extending from days to weeks. The gap between futures prices and the cost of acquiring actual metal for immediate delivery was expanding rather than contracting. These were warning signals that the settlement system was experiencing stress. For business leaders managing treasury operations and capital allocators responsible for portfolio hedging, the implications extended beyond precious metals. This was a case study in understanding how markets function when stress enters the system, how leverage creates fragility, and how price discovery breaks down when different participants operate under different constraints. The sell-off. Monday morning was not irrational given the structure of Western futures markets, but it was completely disconnected from physical supply and demand fundamentals. That disconnection could not persist indefinitely, and the resolution would reveal which regime truly controlled precious metals. Pricing in the long term, the final piece of the puzzle required examining the geopolitical backdrop and understanding why traditional safe haven buying failed to prevent the technical sell-off. The relationship between war and precious metals prices follows patterns that stretch back centuries. But Monday's price action suggested those historical patterns might be breaking down, or evolving into something more complex. Military tensions were escalating across multiple theaters simultaneously. Middle East conflicts were intensifying with direct involvement from major regional powers. Drone strikes had targeted critical infrastructure. Naval vessels were repositioning in strategic waterways. The language from government officials had shifted from diplomatic caution to open warnings. Every historical precedent suggested precious metals should rally during such periods. Yet silver fell $6 an hour. Understanding this contradiction required examining what actually drives safe haven flows in modern markets, and recognizing that the war premium thesis operates differently today than it did in previous decades. During the Cold War era, geopolitical tensions translated almost immediately into precious metals buying. Investors had fewer alternatives for preserving capital during crisis periods. Currency markets were less developed. Bond markets offered limited options for hedging geopolitical risk. Precious metals served as the primary portfolio insurance. The financial landscape has changed dramatically. Today's investors can hedge geopolitical risk through dozens of instruments. Treasury bonds, despite their own vulnerabilities, still attract safe haven flows during crisis moments. The dollar strengthens during risk-off events, even when the United States is directly involved in conflicts. Volatility instruments allow sophisticated traders to profit from uncertainty without touching physical commodities. Precious metals now compete for safe haven flows rather than dominating them. Monday's price action reflected this competition. When markets opened and initial uncertainty drove buying, precious metals gapped higher. But as traders assessed the situation throughout the morning, capital began flowing into alternative hedges. The dollar index strengthened. Treasury yields fell as bond buying increased. Volatility products absorbed speculative capital. The war premium existed, but it was being distributed across multiple asset classes rather than concentrated in metals. The oil market added another layer of complexity to the analysis. Crude prices had surged on supply disruption fears tied to Middle East instability. Energy markets were pricing in scenarios where major production facilities or transportation choke points could be compromised. Oil climbing above $90 per barrel carried immediate inflationary implications for global economies. Historically, energy shocks and precious metals prices moved together. The logic was straightforward. Rising oil increased input costs for mining operations, reduced the purchasing power of fiat currencies, and signaled broader inflationary pressures that drove investors toward hard assets. But the current environment introduced a complication that undermined this traditional correlation. Central banks worldwide were still operating under inflation-fighting mandates. The Federal Reserve had spent 2 years raising interest rates to combat price pressures. European central bank officials were maintaining restrictive policy stances. Emerging market central banks had followed similar paths. Rising oil prices meant inflation risks were re-accelerating, which meant central banks might maintain higher interest rates for longer periods. Higher interest rates create opportunity costs for holding non-yielding assets like precious metals. This created a feedback loop that worked against silver and gold in the short term. Oil rising suggested inflation, which suggested tighter monetary policy, which reduced the relative attractiveness of metals compared to interest-bearing alternatives. The market was trading the central bank policy response to energy inflation rather than trading the inflation itself. This dynamic explained part of Monday's paradox. The same oil surge that should have supported precious metals was simultaneously strengthening the case for continued monetary tightness, which pressured metals prices through the interest rate channel. Central bank behavior patterns added further complexity to the outlook. While Western central banks maintained hawkish rhetoric, emerging market central banks were continuing their multi-year gold accumulation programs. Data showed that official sector purchases remained at historically elevated levels. Central banks in Asia, the Middle East, and Eastern Europe were converting dollar reserves into gold at rates not seen since the early 2000s. This created a structural bid under gold prices that operated independently of short-term trading dynamics. When governments accumulate an asset consistently over years, they typically do so for strategic reasons that transcend quarterly market fluctuations. These institutions were not concerned with technical chart patterns or options expiration calendars. They were positioning for longer-term shifts in the global monetary system. Their buying provided a floor under prices, even if that floor was not immediately visible during leveraged sell-offs in futures markets. The policy dilemma facing Western central banks was becoming acute. Inflation control required maintaining restrictive interest rates, but financial stability concerns were mounting as higher rates stressed banking systems, real estate markets, and government debt sustainability. The longer rates remained elevated, the greater the risk of triggering systemic problems in over-leveraged sectors. Central banks were trapped between competing mandates. This tension created uncertainty about the future path of real interest rates, the nominal rate minus inflation expectations. Real rates represent the true opportunity cost of holding precious metals. When real rates are negative, metals become more attractive. When real rates are positive and rising, metals face headwinds. The current regime featured positive real rates, but the sustainability of that regime was increasingly questionable. Looking forward, the next 30 to 90 days would likely determine whether Monday's sell-off represented a temporary technical correction or the beginning of a more significant repricing. Several key indicators warranted close monitoring. Physical market tightness in China would reveal whether demand was panic-driven or structural. If premiums remained elevated and supply shortages persisted beyond a few weeks, it would signal a fundamental shift in the world's largest gold market. If premiums collapsed and inventory returned to normal levels, it would suggest the crisis was temporary. COMEX inventory levels and delivery requests would show whether paper market stress was building. An increase in delivery demands against futures contracts would indicate that holders were losing faith in cash settlement and demanding physical metal. This had historically preceded major price moves. Currency market behavior would reveal capital flow patterns. If the dollar began weakening despite geopolitical tensions, it would suggest confidence in U.S. assets was eroding, which would be bullish for alternative stores of value. If the dollar remained strong, it would continue attracting safe haven flows away from metals. Central bank policy statements would clarify whether the inflation-fighting mandate was softening. Any hints of dovish pivots or concerns about financial stability would shift the real rate outlook and change the calculus for precious metals positioning. For portfolio managers and business leaders making capital allocation decisions, the paradox contained important lessons. Price and value can diverge significantly during periods of market stress. The mechanisms that normally keep them aligned, arbitrage, delivery, physical settlement, can break down when leverage, capital controls, and regulatory fragmentation segment global markets. Understanding which regime controls price discovery at any given moment matters more than following surface-level price movements. The Monday sell-off revealed that Western paper markets still dominated short-term price formation during New York trading hours. But the Chinese physical market crisis revealed that long-term supply and demand fundamentals were moving in the opposite direction. This divergence represented a transition phase, a period where old pricing mechanisms were showing strain while new dynamics were emerging. The resolution would determine whether precious metals prices were being temporarily suppressed by technical factors in leveraged markets, or whether the fundamental bullish thesis based on physical demand and geopolitical uncertainty was flawed. History suggested that when physical markets and paper markets diverged this dramatically, the physical market eventually won. But history also showed that the paper market could maintain control far longer than physical market participants expected. inflicting significant pain on those positioned for the reconciliation. The strategic takeaway was not about predicting the next price move. It was about understanding that the market structure itself was revealing fractures. And those fractures signaled larger systemic questions about how global capital flows would behave as geopolitical and monetary stability continued eroding. The silver paradox was not just about silver. It was a window into how markets function when the old rules stop working, and new rules have not yet been established.